Hi, my name is Ermira and I work as an investment manager at YUNUS Social Business Balkans. Today we are going to talk about an important subject which is very important not only for the business but also very important for our everyday life decisions. It's accounting and finance. So we are going to explain the functions and the importance of accounting in the company. We are going to talk about the different roles of the financial persons in a company. We're going to explain the most important and major components of the financial statements, starting from the P&L, the cash flow, the balance sheet, owner's equity, and also we're going to talk about budgets, how it's created, what is it used for. We're going to discuss the financial ratios, which are used usually to analyze the financials of a company, because it's not important just to know how to calculate the numbers and the ratios, but also how to interpret them, especially comparing them with other companies, comparing them through the years, and also calculating different ratios into the same financial statement. We are also going to describe the role of the budget and why it's important to develop the financial intelligence into your company and your personal financial intelligence, not only in order to understand the financials of the company, but also to understand the financial status for your personal data. What is accounting? Accounting is the process of measuring, interpreting, and communicating all the financial information to support internal and external decision makers. So, accounting is important for the owners, the stakeholders, in order to know the situation of their investment, was it worthy or not, and what is the return. Accounting is very important for the management in order to plan and control the company. It's important for the employees in order to know how to negotiate their contracts. It's important for the lenders, for example, for a bank, in order to understand the financial status of the company and to make the decisions in order to give or not a loan to a company, for example. It's important also for the government agencies in order to calculate all the tax liabilities of a company and also to approve new issues of stocks and government bonds. So accounting is the universal language of business and finance. As we also know, most of the CEOs of the successful companies, big companies, they come from the accounting world. It's more than 45% actually. Small businesses usually fail because of the poor financing and accounting knowledge, and also a lot of marriages fail because of the poor financial management. So if you want to be successful in business and also in marriage, you should know some basics of finance and accounting too. Why it's important and why it's important that all the staff of your company, your employees, have at least the basic knowledge of your financial status, finance numbers and accounting. It's good to share sensitive financial information between the employees in order to teach them how to understand and how to use those financial statements, how to see the financial information in order to help them work better and understand how their work contributes into the company's success. It's also very important for the outsiders to evaluate the investment opportunity into your business or into other businesses. So it's important for you personally in order to make very thought investment decisions. There are three activities into a company that usually involve accounting. It's financing activities, and with financing activities we mean all the necessary funds which are needed to start a business and to extend it after the first financing, let's say. Investing activities, which mean to provide valuable assets which are required in order to run a business, and operating activities, which are all activities that are run into a business in order to produce goods or services, to generate revenues, and also to consider expenses which are related to these revenues as an important, let's say, element of the financial management. But who are those players or the most important players that do all the financing and accounting procedures into the company? Chief Financial Officer, or CFO as we are used to call him, he is part of the management board, and he is the person which is involved in all the strategy of the organization from a financial perspective. The treasurer is the person which is responsible mainly for the banking relationships, so the relationships with the banks, with the lenders, and also with all the cash flow management, the forecasting, the planning, the investor relations, and also equity and capital structure decisions. And the person which is more internal into the company, which is directly related to using the financial information, to analyze it, to produce financial reports, to make plans, and to help in building budgets, asset management, and internal control. He is the controller into a company, and he is directly responsible to report to the chief of financial officers and to other management board members. So the accounting cycle or accounting process is a set of activities that start with converting the information that the controller gets usually from the invoices, all the receipts, other documents which are directly related to the everyday operations of the company. He is directly responsible to record all this information into the right, let's say, journals, and also to... So how is the accounting process, and what is the accounting process? Accounting process is the set of activities involved into converting all the information about the transactions into the financial statements. It starts with the basic data, which we usually get from invoices, from receipts, and from every other source coming of documents related to all the activities of the company. Usually the controller is the one who gets this information and transfers it or records it into the journals, and all the information which is collected into the journals and the different accounts related to it are then transferred usually automatically, since we use financial systems into computer-based, or in Excel as we are used to do it in the simple way, let's say. They are transferred or posted electronically to individual accounts in general ledgers. So after the classification in the different accounts in the ledgers, everything is summarized into in the end of the accounting period into the financial statements. So this is how usually all the steps into accounting processes are set. The basic, let's say, reports are the financial statements that we mostly know: balance sheet, income statements or profit and loss, statements of owner's equity, and the cash flow statement. What is the income statement? Income statement is, let's say, one of the most important statements that a company has, which reflects its everyday operational activities, revenues and costs related to it. It's the financial record for a period of time for a company, but even though this is income statement as a term is used for a company, it might be useful as a statement even for the personal revenues and expenses that we have every day, because even a person has revenues for a certain period of the year, and also expenses which are done, let's say, monthly. What this P&L tries to measure? It tries to measure if the products and services that a company is generally producing are profitable, because as we know, all revenues are connected to expenses, and if these revenues that we are generating through producing these products or services are not covering the expenses related to it, then we can say that it's not worth it to produce them, and the company is not the product, and the company is not profitable. So this statement reports profit and loss for a certain period and focuses mostly on revenues and costs associated to these revenues. It's usually done in a period of time and explains generally the change in equity between the two balance sheets into different periods. Can be divided into enterprise reports, can be in cash or accrual. Usually the startups, the small businesses, they do it cash-based. The companies which have a more developed financial system, they do it in accrual-based. Personal, let's say, calculations, they are mostly cash-based. As you may see in the slides, you have some samples for income statements. So the income statement, or as it is generally called, P&L or profit and loss, there are different terms that describe it, but it's just one kind of statement. It's divided, let's say, in five main blocks. The first block is sales, and sales show the number, the revenues. It's a number that shows the revenues which are generated from the sale of your products or services. There can be different categories of sales depending on the streams of revenues that you have, because you might have not just only one kind of product or service, but the sum of all these streams is compounded in one number, which is the first row, let's say, in a profit and loss. The second row usually is the cost of goods sold, and it's the cost of all the inputs that you have used directly in order to produce these sales. For example, if we are talking about a company, a bakery which is producing bread, let's say, the cost of goods sold will be compounded into water, all the raw materials that are used in order to produce the bread, but also the direct work of the employees that were involved into the operations in order to produce bread. Operating expenses, it's another line into the P&L statement. Operating expenses are all the other expenses which are used in order to operate in this certain period and to produce these products. And it usually includes utilities, which are water, energy, rent. It also includes internet. It also may include all the expenses for the transport, and it also includes salaries for the administration. Depreciation. So after after the operating expenses, we have depreciation, which is a non-cash expense but reflect a systematic reduction in the value of the assets, which is plant, property or equipment, long-term assets usually, and which are deducted only for the period on which this asset is used. And the last line, or the bottom line, which how it is called usually, is the net income, what remains after reducing all the expenses after sales, and also is the profit after taxes. If we talk, or if we want to use an example of income statement, for an individual, not for a business, which is the simplest, let's say, model that we could use in order to explain it. For example, an individual might have income from his job, so it's his salary, which is in the side of the revenues. And if also this person is studying, it might get, for example, a scholarship, so this is also in the revenue side. If we talk into the expenses side, all the expenses that this individual is doing per month, like expenses for clothes, expenses for rent if he's renting a house, food expenses or tuition expenses if he is also studying, these are all into the expense side. And what remains, revenues minus expenses, is his net income for a certain period. You have this sample in the slide. it's a very simplified form of a P&L for a personal, for an individual, not for a business. Into the business, the income statement is a bit more complicated, especially if it's a big company which has different divisions. And all these divisions, usually companies use P&L or profit and loss statements for every division, which is then consolidated in one big profit and loss statement. So the other components of the P&L or profit and loss statements are the gross profit. What is gross profit? Gross profit is the total revenues from sales minus the total cost for these services or goods sold. So it deduces from the revenues the cost of the products, the direct cost of the products that is related to all the inputs that were used in order to produce this product. It's what is left over basically after paying direct costs, after the company has paid direct costs incurred in making the product or the service. Operating profit or EBIT is gross profit minus operating expenses, including depreciation or amortization. It shows the profit made from running the business. It's the operating profit, and a lot of investors, they look at this number in order to know how is the business doing operationally. And this is calculated before calculating interest and taxes. And net profit is the bottom line. So if you hear the term bottom line, it's about the net profit of the company. So after reducing all expenses, including cost of goods sold, including SG&A, including depreciation, amortization, and taxes, what remains is the net profit of the company. You must be careful on looking at these numbers, because not everything that is written or is calculating means what it really is, because all these numbers, they can be interpreted in different ways. For example, there are different companies that might need to get a loan. What they can do, they need to show that they have very good profit. And what happens? We have different examples. For example, a company that used as a strategy to pre-sell a lot of products, so it booked sales for, let's say, 2 or 3 years, and in its last quarter it recorded all its sales as last quarter sales, when in fact it should have recorded only the portion of these sales for that period. But in the P&L, this company looked great. So all the evaluators, they evaluated the shares of this company in higher. So the price for the shares of the company was higher, and also the banks, when they were seeing at these financial statements, and they looked at the P&L, they saw that the company had recorded a very good profit for the last 3 months, so they were willing to give a loan. But what happened? In fact, after some analysis, or in the next year, it was seen that the company was in a difficult situation, also because the revenues generated, they were not recorded properly. And there are a lot of other, let's say, tricks that accountants, they can do, and sometimes it's legal even, because it depends on the way you interpret things. For example, instead of calculating or recording some expenses as operational expenses, you can calculate them as asset and depreciate them. So in this moment you have less monthly expenses and higher profits. So when evaluators see higher profits in the financial statements, they might evaluate the shares of your company with higher prices, but that doesn't mean that the company is truly doing well. That's why you should know all these numbers and how to interpret them in order to know where to look and to evaluate the company in a different way before investing in it. So other components of the profit and loss statements. Before going to the other financial statement, we're going to talk a bit about the accounting equation. So what is the accounting equation, or what from what it is compounded? In the accounting equation we have assets, we have liability, and we have owner's equity. So what is asset? Assets are is anything or everything of value that a company owns. Liability are all the claims against a firm's assets by creditors. So in assets we put usually short-term assets, which are all the cash inventories that a company is holding, or accounts receivable. And in the long-term assets we have all the equipment, we have plants, we have buildings. In the side of the liabilities we usually have short-term or long-term loans. So we have short-term liabilities, which are payables to all our suppliers, and the portion of the long-term debt which is due in that particular year. And we have also long-term assets, which are usually loans, all the loans that we have got from our creditors and that are due that we have to pay for several years, and not short-term loans. Owner's equity are all the claims of the proprietor or of the partners, of the stakeholders of the company against the assets of the firm. And owner's equity is equal to the excess of assets over liabilities. So the basic accounting equation is assets are equal to liabilities plus owner's equity. And this is very important. It's used in all financial statements. It's used basically mostly in the balance sheet, in order to see if the accounts of this company, they really balance. So what is the balance sheet? The balance sheet is the statement of a firm's financial position. So what it owns and what it claims against its creditors, against its assets at a particular point in time. So if the P&L is, let's say, it can be done every month, or it's done for a certain period, the balance sheet, it has a proper date. It's the situation, the financial situation of a company in a particular point in time. It's the photograph, let's say, it's like the photograph of the firm's assets and liabilities, and also owner's equity. So just as why it's important is just because the goal of the company is to create profit and to increase the profitability. Another one is to increase equity, because if the stakeholders, the owners of the company, they have invested into the company, for sure they need to see profits, and the final result is to see that the value of their equity is growing over years. So what, in fact, that equation show is the accumulation of profit and loss, ideally profit, because nobody is investing in a company thinking that it will accumulate only loss. Investors are expecting to accumulate profits. And everything is shown into the retained earnings, which is usually positive, let's say. It's following, as I already said before, it's following the accounting equation, assets minus liabilities. It should be equal to the owner's equity. What does the balance sheet present? For sure it has a date on it. Usually companies, they close their balance sheet into the 31st of December, but depending on the accounting periods, they might close it earlier. Like some companies, they close it by the end of September, especially in US. It's broken down into several, as we explained before, we have two main categories. We have the asset side, we have the liability side, and we also have shareholders' equity. Into the asset side, we have current assets, and we also have long-term assets. What we usually put into the current assets is all the assets which can be easily converted into cash into a short-term period, which means into 1 year. We put into the short-term or current assets, we put cash, which is cash that we usually have into the bank, so the balance sheet, the balance in the bank account, cash in hand. We also put accounts receivable, which are all the sales that we have made and that will be converted into cash into 1 year. And we also put all the inventories that we have of raw materials, products in process or materials in process, and also ready-made, let's say, or products which are ready to be sold in the next period. Into the long-term assets, we have all the assets that we use for several years and not only for one period. And into this category, we usually put land, which cannot be depreciated, we put buildings, and we put also equipments. The way that we evaluate assets is usually, there are two ways. One is into the book value, so the value of the assets in the period in which they were built, or we can do an asset evaluation every period of the year. Usually companies use the first method, which is the book value. We put here the net long-term asset value, which means the book value minus the depreciation, accumulated depreciation into years for the period that we have been using them. The second big category is liabilities and shareholders' equity. We have short-term liabilities and we have long-term liabilities. Short-term liabilities are payables or money that we owe to our suppliers, to salaries for our employees, which usually should be a very small value. It can be liability for 1 month, for example. And these are liabilities which are due in less than 1 year. And it also includes the portion of the long-term debt which is due during that year. Into the long-term assets, we have usually loans from our creditors or loans from stakeholders. These are long-term loans that we have to repay for more than 1 year. The last category, which is also in the side of the liabilities, is shareholders' equity, which includes the claim of the owners against the assets of the company or of the firm. Is the difference between the total of assets of the company and the total of the liability. Usually we use this in order to build the statement of owner's equity. But before going to the statement of owner's equity, let me explain a very simple example of the balance sheet for the personal data of an individual. So I'm not going to explain a sample that you already have in the slides about a company, but I will simplify it in order to make it more concrete and that you understand better, involving the financial data, if it can be called like that, of an individual. So in the asset sides for an individual, short-term assets can be cash that the individual has at home, let's say, or in his pockets, and the cash that he has into the bank. As long-term assets or fixed assets, there can be equipment that he has bought and he has into his house, a car if the individual owns a car, or all his wardrobe that he's going to use for more than 1 year. So this is more or less the asset side of an individual balance sheet statement, let's say. If we go into the liabilities category, the individual might have a short-term loan, which is an overdraft, or it can be, let's say, the credit card, which is payable during the year. And as a long-term loan, the long-term asset, we can mention a loan, for example, that the individual has been taken to the bank for more than 1 year. It can be a loan for a house, it can be a loan for a car, or different types of loans which are due into more than 1 year. Then what remains after reducing, let's say, liabilities from the total of assets? It's what the individual owes, or the total owner's equity. The statement of owner's equity. This is a statement which is designed to show the components of the change in equity from one year to to the other one for a business usually. It begins with the amount of equity which was shown in the balance sheet, and we add here lines which are taken from the income statement. So we had the net profit from the income statement, or we reduce the net loss if in that particular year the company was with loss. And we reduce dividends is if the company has distributed dividends, withdrawals from the family if the owners they have withdrawn money from the business, and also if there were investments, let's say in new shares, or the company has rebought its shares, this will also affect the value of the equity in the end of the year. Also reevaluation of assets, that would affect the equity of a company. So there are two ways to increase the equity for the owners. The first one is new investment in the business, which means cash investments or equipment investments, or revenues earned from the business, which is the net income of the period. And there are two ways to decrease the value of the equity. First one is expenses, so using assets to generate more profit or incurring new liabilities. And the second way is taking money or withdrawing money from the business for personal use or just dividends. These are the two ways how the owner's equity is reduced. So we talked about the balance sheet. We talked about the profit and loss statement, and we talked about the equity value statement, or owner's equity statement. There is another statement which is very important, and at which the investors are looking more and more, because since some periods ago investors were looking more at the profit that the company was making. They understood step by step that not only that is important, but there is another statement which shows the cash movements into the company, which is as important as the P&L statement, on which the investor usually go and see. Why is the cash flows statement important? Profit is not everything. Profit is very important, but profit is not cash. That means that in the end of the month, a company can make profit, but if this profit is not converted into money, the company will have problems, because in the end of the month you cannot pay your employees or your suppliers with profits. You need cash in order to pay all of them. So why is important? We said because the company needs to pay its bills, and we need to know if the owner's equity has been growing over time. We need to know all the firm's cash receipts, cash payments that represent an important information for the use of the cash into the company. There are three categories of accounts that go into the cash flow. There are cash inflows and cash outflows for operating activities, for investment activities or investing activities, and cash in or cash out for financing activities. Into the operating activities, we have cash inflows or outflows which are directly related to the operations of the company. So everything, every cash in or cash out which is directly related to the sales and to the expenses of the company for the period. It generally results from the purchase and sales. The inflows generally result from the purchase and sales of the products, and outflows usually are result from the purchase of different inputs or services. Investing activities, these involve the acquisition and sales of different assets for the company, and they can also involve, let's say, the acquisition of shares into other companies. We have financing activities. These financing activities, inflows or outflows, they might result, let's say, from different liabilities that are created from a loan, from short-term loan, long-term loans, or from repayments of long-term liabilities and capital stock. So cash, in fact, is a reality. Cash flow, in fact, is a reality check of how the company or the business is run, and that's why investors look more and more at this financial statement. It's different from profit, as we said, and in fact, you need both. You need also profit, and you need the cash into the company in order to operate. Because in order to repay all your duties, you will need real cash and not just profit, which is written into a paper, and is something that you will get maybe after 1 month. In order to explain how important it is, I can give you an example. If a company let's say into production, a company that is producing furnitures, they have a good month, let's say, they are creating profits by the end of the month, they have sold big quantities, 100,000 of sales of products, but they will receive the cash into the next 2 months. But in the end of the month, they will have to pay for all the raw materials that they have bought, they will need to pay the employees, and if they don't have all that cash into their bank account, they won't be able to repay anything, and the company can go in bankrupt. And that's the reason why a lot of startups, they go in bankrupt. Indeed, they can be profitable for the period, but they have discrepancies in the cash flow. So that's why the cash flow system statement is a very important statement, and a very important information also for all the managers in order to plan effectively the cash that they should have each period in order to cover these gaps from the profits or from the revenues recorded and the cash that comes into the bank account. As I previously explained, there are 3 main categories into the cash flow system statement. The first category is cash from operating activities, so the cash inflows come from the sales of the products of the services, and we have depreciation into this category, because since the depreciation is not cashed out into the P&L, it will be added into the cash flow from operating activities together with the net income that comes from the P&L statement. We have changes in inventories that go into the operations cash flow, and we have cash from accruals. So if the category of accounts receivable is changed, the change is recorded into this segment, let's say, of the cash flow statement. And if we have any change in accounts payable, this also goes here in the working capital change. The total cash flow from operating activities is the first category of the cash flow statement. The other category is the category of the cash in or cash out that comes from investment activities. Usually we have cash out here, and it goes basically mostly for the purchase of the long-term assets. And if we have any change in the short-term investment, that's the category where it goes in. We have cash flow from financing activities. So if we get a loan from a bank, and that would be recorded as a cash in. If we are repaying the principal of this loan, then we have cash out recorded into the cash flow statement. So every change into the short term, into the long term liability is recorded into the change, the cash flow from the financing activities. So the amount of these three different categories of cash flows from activities of the business, it goes into the net cash flow. And adding the change, adding this change into the cash flow through the year into the balance of the cash from the previous year, we get what the ending balance of the cash of the company is in the end of the year. And this is for the cash flow statement. We have, as I said, 4 different cash flow We have 4 different financial statements, but it might be easy maybe to calculate them, to put numbers. But what do these numbers mean? We need some ratios in order to understand how really the company is going, in order to understand different indicators into these financial statements, and also in order to compare this financial data with other companies and with the industry. So we have different financial ratios. We have different categories. We have liquidity ratios, we have efficiency ratios, we have leverage ratios, and we have profitability ratios. There are more than 16 different ratios which are used in order to evaluate the financial situation of a company. But we are not going to, let's say, see each of them. We will look at some important ones in each category and see what they mean for a company. Let's say that each of these ratios has its limitations, and each of them needs a proper interpretation. Sometimes it's very important to analyze several of them in order to understand also the context and to understand how the financial situation of the company really is. So let's start with liquidity ratios. What do these liquidity ratios show? The liquidity ratios usually show the ability of the company to convert his assets into the liquidity. Liquidity ratios usually show how able a company is to repay its debt. So we have 2 very important indicators or ratios under this category. We have current ratios, which compare current assets to current liabilities. And as we said, into current assets go all the cash that we have, or those assets that can easily be converted into cash. So cash, inventories, or accounts receivable, divided by the current liabilities, that portion of the debt that we have to repay. And another liquidity ratio is the ACID test, or quick ratio, which measures the ability of the firm to meet its debt payments on very short notice. So basically it's the current ratio, but without inventories. So this is a bit more strict than the current ratio, and both of them, so especially the current ratio, it should not be below 1, because it shows that the company is not able to repay its debt. And usually banks, they look at these ratios in order to understand how able is the company to repay the loan, in order to make a decision on giving a loan or not to this company. Generally, a ratio 2 to 1 for the current ratio is good to have, which means to assets, they should be double the liabilities of the company. 2 important indicators into the activity ratios is the inventory turnover ratio, which indicates the number of time a merchandise moves through a business. It's calculated through cost of goods sold divided by the average inventory, which means inventory in the first period plus inventory in the second period divided by 2. The total asset turnover ratio, this is total net sales divided by the average total assets, and indicates the business ability to generate sales in reaction to his total assets. Another category of ratios which is very important, especially for investors, that's the ratios on which they look mostly when they want to invest in a company, are profitability ratios. Why these are important? Every investor, if he wants to invest in a company, he needs to know that it's the value of its shares, it will grow, and at least the company will have profit. It measures the company's overall financial performance by evaluating its ability to generate revenues in excess of operating costs and other expenses. So we have several profitability ratios. We have a gross profit margin, which is gross profit divided by sales. We have net profit margin, which is the same, it's net profit divided by sales, and return on equity, which is net income divided by average equity, and that's the indicator on which the investors they look a lot, because they see it as very important in order to know the value of the equity through years. So if we see each of these indicators on its own, it would be difficult for us to understand the real situation of the profitability of the company. In order to know it better, we need to compare it with the margins of the industry, or even to compare it with other companies in the same industry. Leverage ratios are another category which indicate the financial performance of the company. They measure the extent to which a firm relies on debt financing, and this is important especially for creditors. So we have the debt ratio, which is the total liabilities divided by total assets, and that show the liabilities for $1 of assets on which the company has invested until now. It shows its ability to absorb a reduction in assets without hindering its ability to pay creditors. Banks don't like that much a company that is relying too much on liabilities, but also if this ratio it's very small, let's say, if this ratio is too big, it might mean not only that the company is using too much debt, but it's also not investing that much in assets, because the value of its assets is too small. Another indicator is long-term debt to equity, which is long-term debt divided by owner's equity. A total liabilities to total assets ratio bigger than 50% would indicate that a firm is relying more on borrowed money than in owner's equity. These are the most important financial ratios that we look at. There are others, but these are good to know for a person that is not going to the accounting side and needs the basic of accounting and financials, and needs to know what to look at when he's, let's say, evaluating a company for an investment. We talked about this financial statement, we talked about some indicators for the financial performance. We need to know also what the budget is. The budget is a planning and controlling tool that reflects all the firm's expectations regarding to sales revenues and expenses throughout a period in the year. Why do we do that? We do that in order to compare the actual situation to the plan that we had in the beginning of the year, in order to know how the company is going, in order to see the company's performance, but also to plan effectively the cash situation of the company, because If the cash out exceeds cash in and the company is not prepared, it might go into bankruptcy. So the cash budget is a very important tool for a company to have, and that's what the companies they do every year in the beginning of the accounting period. So it's good to have in order to outline a plan for managers and employees, so both parts they know where they are going, and also in order to make effective pricing and spending efforts. Benefits of a good budgeting would be there is an enhanced communication, so better communication between managers and employees. The accountability is reinforced, so everybody knows where we are going and everybody knows his own part. It might identify problems in early stage, but it also serves as a tool in order to motivate the employees, because having a budget means that you have clear, let's say, targets on where you are going in each period. Now it's time for some exercise, so you have some questions which you can answer using the information that you got during these lectures. Thank you.